Welcome to PhillipCapital's Weekly Market Watch. The news coming out of Dubai over the weekend has caused a lot of concerns among investors. Today, we have Mr. James Chua, investment analyst from PhillipCapital Management, to tell us more. So James, do you expect some money market or bond funds to be affected by the Dubai incident?
We don't expect money market funds to be immediately affected. Typically what happens with money market funds is if the debts get written down, then at that point the debt that is held in the money market fund portfolios will be written down at that point in time. For some of the bond funds which have a mark-to-market component in the way the NAVs are valued, you will see some of their prices correct. And then of course if those debts finally are not paid, then it has a further adverse effect on those bond funds out there. But I like to say that the fixed income and the money market funds that we do manage have no exposure to the Dubai incident over the weekend.
Does this in any way affect your Singapore or US dollar money market fund?
As mentioned, we don't have any direct exposure to investments in the Middle East. Typically, we do not buy what we do not understand, and frankly, we don't spend much time looking at debt coming out of the Middle East. We're fortunate in this event not to have any exposure to anything related to the Dubai incident.
Now moving on to equities, I noticed you have used a AAA model to determine positioning in the market. So what is this model saying at this moment, and can you tell me more about how the model works?
Yeah, so what this model is an asset allocation model. So it tells investors when to invest in bonds and when to invest in stocks. In a typical investor's portfolio, you would rarely have 100% in stocks and 100% in bonds. So the way that this is used in asset allocation is that it would tell you when you want to be more positive on stocks or more positive on bonds. What it does is that it has three main inputs. It looks at valuation, it looks at economic variables, and then it looks at prices. It really is a very common sense way of what any investor would ask themselves by saying, are prices too expensive, or what does liquidity look like? And then also, what does the economic situation in the globe look like? And the model takes all these inputs and it spits out a number that tells you what your optimal asset allocation into equities or bonds should be at any given point in time. And right now what the model is saying is that it wants investors to overweight equities. Actually, the model has been overweight equities since April 20th. If you bought a simple Asian index fund or a pretty good fund, which is our Phillip Asia Pacific Growth Fund, on April 20th and held it to today, you would have gone up about 30%, since the recommendation. And
on a sector basis, what kind of stocks are you looking at and why?
Yeah, I think there was this survey done by Asia Monitor recently talking about why Chinese consumers have such high savings rate, and the main reason is because of concerns over health and healthcare. A typical Chinese family that has a member who has suffered terminal disease such as cancer can easily have their lifetime savings wiped out in a single swoop. So when a lot of fund managers out there talking about wanting to capitalize on the high savings rate of Chinese companies by buying retailers, what we're saying is we're really taking another view, which is to say that we believe that on the agenda of what Chinese consumers have to spend on, they really have to spend on healthcare much before they even spend on buying clothes, for instance. So we like healthcare. We feel that it has a very inelastic kind of demand. It has a lot of upside in China in particular because of the kind of qualities that are being experienced across the board. We also think that there's a lot of strong rhetoric coming out of the Chinese government, and recently when we look at the space, we've seen that a lot of the funding that has gone into improving Chinese healthcare has actually been flowing into the books of a lot of the Chinese healthcare companies. You got to be careful if you look at the space because you get a lot of smaller names out there, and a lot of these companies are not linked to government, so you don't have that typical QC that you do if you're buying the China mobiles out there. So yeah, you really have to do your bottom up and yeah, these names have been moving recently, and they've been working for us, and we continue to invest in them at the moment.
Thank you, James. That's all we have for you today. Tune in next week for more market updates.